We're pleased to welcome Andrew Elder as our first speaker in our first webinar. New times call for different innovations, and we're very excited to have Andrew here. Andrew started as a surgeon and then moved into consulting, where he specialized in healthcare strategy. He now focuses on medical technologies and digital health. He joined Albion Capital in 2005 and then became a partner in 2009. Andrew also oversees the management of the UCLE Technology Fund. This webinar is going to focus on VCs during and post-pandemic. And if you have a question at the end after Nandin and I ask a few questions, just please virtually raise your hand and we'll select you so you can ask Andrew a question yourself. Thank you so much, Andrew, for being here again. And Nandin, would you like to start us off with the first question?
Sure. First of all, thank you so much, Andrew, for joining us today. It's really a pleasure to have you. Thank you. So you have really had a very wonderful career path, from a neurosurgeon to a consultant and now venture capitalist. So can you tell us more about your journey and why did you choose to move along these roles? And also, did you always plan to end up as a venture capitalist?
So thank you very much for having me. And yeah, a good question. It takes me a long way back in time, but it was a pretty big decision to make. So I do remember vividly. When I went to medical school just because I love biology and medicine and understanding how all that worked, and I got fascinated by life sciences. And whilst I was at medical school, actually, I just had an inkling as to the fascination of the commercial world and not just the academic or clinical world. And a few friends went off into the commercial world, and I just thought it looked really interesting. And I kind of followed them and tracked them, but at the same time pursued my medical career and was working out what I wanted to do. And I realized that I loved aspects of medical and academic research. I loved aspects of surgery, but I didn't love them all so much that I wanted to spend my whole life doing them. But what I was really fascinated by was the commercial world. And I don't know quite why it fascinated me, but I think it's the variety and the fact that you're thinking about so many different variables all at once. I think it's the fact that it impacts our lives in so many different ways. And all of that just seemed just really interesting. So a career which could combine both the clinical, the academic research, and the commercial just seemed like a good way to go. So during those sort of 6 years that I was working as a surgeon, it just grew and grew in the back of my head to the point where I said, look, I now have to just go give it a go. And I did. And I've never really looked back. And that took me, it took 5 years or so to learn the commercial ropes before getting into VC. But when I made that jump, it was always with a view to doing VC.
Right. Thank you for your answer.
Sorry, I was just on mute. Thank you, Andrew. So with such low interest rates and cheap capital in the markets at the moment, have you found that zombie companies have been kept alive and are negatively affecting businesses by increasing the competition in the market? Or have you found quite the opposite? With reduced demand, have you seen good companies suffer financially in a way that doesn't reflect their solid business models?
So that's a good question. So negative interest rates and capital market are big macro drivers which affect large chunks of our economy. But in the venture world, we're backing companies which are loss making by structurally, by innately they are loss making. So the idea of zombie companies in our world is not quite the same as zombie companies in the sort of general commercial world, where you've got lots of businesses which are trying to be profitable, should be profitable, being propped up when they shouldn't really be there. We're investing in the world of companies which are developing technologies or developing innovative business models, which in the outset are always going to be loss making. And so we provide the capital for those, and we really shouldn't be investing in anything where there are zombies. But having said that, your question in terms of macro, I'm sure there will be a lot of zombie companies propped up, a little bit like as they were back in 2008-9 financial crisis. But it's not really the world that we inhabit. Where we inhabit, the important things are how much liquidity and capital there is in the private equity and venture capital markets, and how big those funds are, and whether those funds are investing and able to invest in good quality opportunities. That's what keeps our wheels moving. And right now, there's enormous amounts of liquidity in private equity and venture capital markets. I think there will continue to be, especially when the public equity markets are very much up and down at the moment. There's negative interest rates. Where do people find a home for their capital? Well, alternative assets is a usual place to go, and private equity and venture capital are alternative assets, which should be partly decoupled from the sort of usual macroeconomic cycle. So investing in innovation, I think is going to be a lot of capital chasing that innovation over the next sort of 5 years or so. And I think the COVID thing, actually, if anything, should improve that. We're going to lose capital in certain sectors, the obvious sectors, the leisure, hospitality, oil and gas, aviation, all those sorts of sectors are going to have a hard time. But in those technology-driven sectors and healthcare and life sciences, those are the sectors that are really, really going to win out. And combined with the sort of large amounts of liquidity and capital coming into alternative assets, I think it should be a good opportunity. There should be plenty of capital to build good companies in those sectors.
Interesting. And just to follow on from that, so as you said, we're obviously seeing a decline in areas of where there's lots of face-to-face contact. Do you think that sector will see a boom post-pandemic, post-quarantine? And do you think that'll sort of actually, because as you said, of the increased capital and liquidity, those sectors will also benefit from that? And not just the technology companies and healthcare companies.
Yeah. So, I mean, I think if I understood your question right, it's those companies with a business model which involves a sort of remote element to it, and so in healthcare, we're definitely seeing a big pickup in that. So anything where there's now typically that needs some sort of technology to make that connection, a remote connection, whether it's devices or whether it's video or a combination. But healthcare and life sciences, we're seeing a massive uptick. Everything from primary care to mental health to secondary care follow-up on the health side, but also in life sciences, so running clinical trials and so on. Just because of the sudden fracturing in the normal world with COVID, we're having to suddenly bridge that gap of connection. So we're using technologies. People are suddenly deciding to use technologies. In a week or two, they're suddenly saying, well, we have to now use technology. They should have been using it before, but there were barriers to them adopting it. So we've seen probably an acceleration of 3 or 4 or 5 years of normal cycle adoption just happened in 3 or 4 or 5 weeks. So that's great if you're invested in those business models or those technologies which can enable remote monitoring or telecare or anything like that. So fortunately, we're quite long on those. We've got a big digital health portfolio, which is all about capturing data in some sort of structured software-based remote way. And so we're pretty bullish on the outlook for digital health in particular. But it goes beyond just digital health. There are a number of other sectors where that model of whether it's shopping from home or doing things are going to be very, very positively impacted. So that the world that we're living in terms of business models is definitely not going to be the same again as a result of COVID.
Even post-pandemic, even do you see it long term or just in the short term?
Yeah, no. So there's definitely going to be some rollback. I mean, I'm not, be nice in lots of ways if there wasn't, but and in the regulated world of healthcare, the regulators are definitely going to roll back a bit. But I think now, having seen the light, having seen how easy it is, and having seen just the benefits and the efficiencies you can gain from it, from using technology, there's no way they're going to go all the way back. And if they did, then we have just missed the biggest opportunity of our lifetime to improve efficiencies. But yeah, so I think who knows how much. Every sector is going to be slightly different. Some might roll back 10, 20%. Some might roll back 50, 60. But I think the landscape generally in every sector will be quite different. in every case. There'll be almost no sectors which are completely unchanged.
Interesting. Thank you.
Thank you for that answer, Andrew. So in this age of disruption, we have seen a lot of innovation happening. So do you see something, are you working on something really interesting or something really innovative that you think or you feel that could be a game changer, or something that you've read about could potentially affect multiple industries or could be really beneficial in the healthcare industry as well?
So we're working on a lot of things, a very broad range of things. And I mean, the UCL Tech Fund is a great place to start in terms of exciting things that we're working on, because there's just an enormous myriad of exciting technologies coming out of UCL. It's a real privilege to work on them. And a lot of it is life science. So that's my area. That's great. So we probably about 70% is in life science areas. And the real areas that UCL excels in, apart from, excels in lots of areas, but the ones that really stand out in terms of being super innovative and super high impact over the next sort of 10 years are cell and gene therapies. And so the general sort of theme of personalized medicines driven by very highly tailored treatments, it doesn't get much more tailored than cell and gene therapies, and UCL leads the world in this. It really does lead the world in cell and gene therapy. So we're working on a lot of interesting technologies, whether it's gene therapies for brain function, whether it's cell therapies for cancer, whether it's gene therapies for vision. So we're seeing stem cell therapies that are curing blindness. We're seeing cancer treatments which are curing cancers which were never thought treatable. We're seeing gene therapies cure kids of terminal illnesses which were never previously treatable, and we're seeing cure rates in the 90 to 100% level. So these are sort of really world-changing sort of technologies now coming through, and what's great about it is they've been worked on for the last 20, 30 years, but they're now really coming to market and working. So there's this confluence of technologies, which means these technologies, no technology sits on its own. Most of them are built on previous technologies and other technologies which enable them to work. And so this confluence of technology just now means some of the tools we have are so powerful, whether it's CRISPR gene editing, or whether it's gene vectors, or a whole range in just genomic sequencing and so on. All these come together to mean our tools for precision medicine are super powerful. And the great thing is UCL is right at the forefront on a lot of those. And we're seeing parts of the sort of parts of the body's cellular makeup now being harnessed where they just weren't before. So we're seeing new types of T cells being used now in this way. So opening up huge areas of disease which we couldn't combat. And then the other big area that UCL is brilliant at is computer science and machine learning, as I'm sure you all know. And so again, the UCL Tech Fund's involved in some of the really exciting things coming out of there, and whether it's quantum computing is a hugely exciting field. It's been through several quantum winters. Is this going to be the quantum summer? Is it summer here to stay? Who knows? We just don't know. But whatever's happening is looking really exciting. And typically with all these innovations, they go through waves and they have winters and summers. And as each summer comes, it looks a bit bigger and a bit more exciting. You never know if it's going to go away into a winter, but it looks like this one's got a much better chance of sticking and staying. And we're involved with a business on that side at a UCL, which writes software for some of the biggest, most powerful quantum computers in the world. And, seeing the power of what these guys are doing is just extraordinary. When you think there's a potential there to break blockchain, capabilities and so on, it's just extraordinary what they can do, and harnessing that for the good of the world is going to be really exciting. Some of the problems they're working on with that quantum compute is just super exciting.
Thank you for that answer. Just to follow up on that, you have invested around 23.4 million from the UCL Technology Fund into different ventures.
It's so what do you think? Now, actually, we're well over 30.
Wow. Okay, yeah. 30 million pounds. That's really great. So, what have been the previous previous ventures that you've invested in, how they have changed because of this disruption? So I'm sure that there might have been something new which might have come up, and how is that different from what was there previously?
Do you mean in terms of what's been impacted by COVID?
Yeah.
So actually, the impact on the portfolio itself has been fairly minimal. And I suppose there's two aspects of disruption. There's the short-term disruption of labs being shut and customers not being behaving in the same way. But then there's the sort of impact on long-term business opportunity and market opportunity. In terms of the near term, there's been a bit of disruption with labs being closed, but it's not been huge because all of those businesses, most of them are in development stage. They're developing their technology. They're not so impacted by any market forces going on at the moment. So they're slightly sheltered. Once we're through this early sort of lockdown and ease of lockdown period, we're not anticipating any major problems for the portfolio. On the life science side, in terms of the opportunity, look, there is a bit of disruption in the health system whilst people are focused on COVID, and there'll be some budgetary issues and so on generally in healthcare. But the kind of things we're investing in, again, as I said, we're investing in super innovative new treatment paradigms like cell and gene therapies. Those aren't going away in a hurry, and the healthcare need is still going to be there. And so by the time these sorts of technologies are coming through the market, I don't think we'll have any big negative impact of COVID. I think on some of our other portfolio, on our digital health portfolio outside the UCL Tech Fund, we're actually seeing big opportunity long-term from COVID because of the way that the life science and healthcare world will now have shifted to a much more sort of remote data capture, remote treatment, and remote monitoring of people. So clinical trials will be done more virtually. Software platforms will be used much more in life sciences and healthcare to capture data and engage with patients. And we think that's just been accelerated with COVID. So we're seeing long-term opportunity on the digital health side. And then on the computer science side, clearly every computer service or product is facing another sector. So where those sectors are impacted, then there's going to be short-term impact, but a lot of these can pivot. So we've got a lot of investments in machine learning companies which are providing tools or platforms to, say, optimize machine learning or apply machine learning better. And if they're in financial services, then that's going to be some impact short-term on financial services. But fundamentally, if they've got a good product proposition, they can add value to the customer, these things are going to be valuable in the years to come. So we're pretty positive about long-term impact of COVID on our portfolio.
Sure. Thank you so much. It does teach a lot about our own institution and tells about the industry as well. Over to you, Thea.
You mentioned earlier, Andrew, so you've said that people actually are looking for somewhere to put their capital, especially with negative interest rates in some countries. So even though a lot of countries are in economic turmoil and the markets are so volatile, have you found it difficult to entice investors to risk their money in the market, or quite the opposite? And what are your predictions for people's trust in the market in the future after the pandemic?
Yeah, good question. So I'm actually out fundraising at the moment. So, but I think, and I'm fundraising for the successor fund for UCL Technology. So we're actually very close to raising the second fund. And there's no doubt that COVID's had a short-term disruption. Anyone allocating money tends to allocate money across on a portfolio basis. And when a big chunk of most people's portfolio has public markets assets in there, and when the public markets crash, then the value of that part of their portfolio crashes, and suddenly their portfolio balance is quite different. And so someone then allocating funds to private equity or venture capital or alternative assets will suddenly say, well, actually, I'm now overweight in alternative assets because my public equity markets part has gone suddenly underweight because of the market correction. So what that does is it tends to put people on hold for a while. They're just suddenly, they'll just stop and just wait for a while. They won't do anything. especially when it comes to alternative assets. So what we're finding is there's not that many people piling into alternative assets, but prior to the COVID epidemic or pandemic, there was already a lot of liquidity in the market. So there's no short-term issue. There's a lot of dry powder, as we call it. So funds which are allocated already to, so money that's been allocated to funds but not yet deployed within that fund. There's a lot of that dry powder still to be invested. So fund managers who deploy the dry powder are still very, very busy. We've still got lots of opportunities to go for and lots of funds to go and deploy. There will be a hiatus around about this year and maybe into next year where raising capital will be tricky because of that paralysis problem I mentioned. But then long term, I think, as you say, you pointed out, the long-term asset allocation drivers like negative interest rates and volatile public markets should mean that the alternative assets come back on pretty strong. And then so when people are re-upping their allocations to funds, we'd expect that to come back. And then the other point then is around particular sectors. So where there's deemed to be a big uptick, you will see funds being still deployed. So if you're focused on life sciences or health, or if you're focused on technologies such as anything to do with remote working, remote service delivery, anything like that, you're going to see funds raising large amounts of capital right now, because right now is the opportunity. So you'll see, very sector-specific funds still raising. In general, you'll see a bit of a paralysis right now, but it will start to come back. And I think long-term, it should be pretty positive.
Great. Thank you. Nandan?
So the next question is related to a firm that you worked with, Aditya Informatics, which is a company specializing in differentiated informatics platforms with cutting-edge analytical tools to support healthcare and research. My question is, has there been recent developments related to COVID-19 at firms which specialize in such informatic platforms, and how they have changed their operations?
Yes. So this is one of the areas where COVID is having a positive impact, I think. And I can't talk about company specifics, but just talking about at a general level, one of the things that's come out of the whole COVID pandemic is a massive acceleration in global collaboration of academic groups and industry groups around the world. It's been quite extraordinary, the number of partnerships that have been set up in record time. These things take years to develop normally, and suddenly within the first 4 to 6 weeks, there were, literally thousands of pan-industry and pan-academic collaborations and sharing of information in a way which never happened before. And one of the big industries, certainly in life sciences, is integration and sharing of data. One of the great tools we've got now at our disposal is machine learning algorithms, but they require really, really high quality and large data sets. And healthcare is full of very large data sets, but of very low quality and very unintegrated. And so the real key to getting the insight out of those data sets and using machine learning tools to do that is to be able to integrate and improve the quality of those data sets. And this is what both platforms like the one you're talking about are able to do. So they're able to bridge the world and bridge data sets all around the world and ensure high quality data structuring and high quality integration of data, which means that you can then put machine learning tools on top and get good insight. So that's the concept which prior to the pandemic was really starting to take off. That was driven by machine learning capabilities and the desire to use those. And platforms like that were really coming into vogue because they realized just some of the problems about integrating and collecting large data sets. The thing that COVID's done is it's just accelerated all that collaboration, and it's accelerated that need to share data around the world. And so platforms like this have now been almost sort of not hijacked, but they basically said, look, we need a platform like this. You're using it for, maybe it's a cancer program or a dementia program around the world. Well, actually, can we now use that same platform to go and run all our vaccine trials through, or all our COVID therapeutic trials through? And how can we get insight from the, thousands of trials, again, just all set up around the world on COVID? within 3 or 4 months. So companies like that are working with big charitable organizations, pharmaceutical companies who are involved in these collaborations, are right at the heart of it.
Sure, thank you so much. It's great to learn about how data has been shared nowadays and has improved meaning to everyone's life. Over to you, Thea.
Yes, thank you, Andrew. So Umotive is another company you work with, which provides patient engagement and data capture, is a data capture platform for use in real-world and observational research. How have they transformed operations to support COVID-19 data collection? Is it just, have they also been involved in collaborating with different countries and expanding in that way, or has there been other developments also?
Again, I'm not really allowed to talk too much about the specific companies, but I think, yeah, what you pointed out is that that company is involved in capturing data from clinical trial situations, whether it's real world clinical trials where pharmaceutical companies are trying to understand the impact of their drugs on patients, or whether it's pre-approval, so clinical trials where they're being done to assess safety and efficacy to make sure that the drugs are actually going to be able to get through to market and through to approval. And they work on both of those. And I think what we've seen in that market is, again, a series of sort of short-term impact of actually lots of trials have stopped or been paused, whilst lots of COVID trials start up. So there's been a bit of a swapping in and out. And so companies like that have to do a bit of a quick switch, which is we've got to pause some of the things we're working on, but actually, you know, companies are coming to them saying, well, we're working on this COVID trial. We need something straight away, straight out the box. So they're having to be very rapid responders, and they're having to switch to different types of trials, but essentially it's working with the same types of customers in the same way, just focused on a different disease. And then there's the sort of medium and longer term impact on that industry as a whole, which is pharma companies are very slow to change. They tend to do trials. I mean, they are shifting to doing digital trials, but in the past, they all used to be run on paper, and they were very inefficiently run. And the last 10, 15 years has seen a big shift of trials run from using paper to digital. But there are lots of different aspects in data collection in a trial, and still large chunks of that process are still manual and paper. And so what COVID has done is said, look, we now have to run our trials remotely. So if we want this trial to carry on, we have to be able to manage this patient not even getting into the hospital sometimes. They're not even allowed into the hospital. So how are we going to get data back from the patient? Well, we're going to have to roll out tools which use mobile phone platforms. And so they're having to shift to using a lot more technology very, very quickly. And we see this being one of the beneficiaries, the sector being one of the beneficiaries of COVID and more rapid adoption of digital tools. And we'll see, not purely virtual trials, but we'll see a much more hybrid models where patients sometimes do have to go into the hospital, but actually a lot of it can be run remotely with data capture platforms and patient engagement platforms. So we see a lot more use of software coming in to the pharmaceutical industry in the whole trial space long-term as a result of COVID.
It's very interesting. It's so interesting to see how the pandemic has actually streamlined and sort of fast forward a lot of these processes, which have been sort of building up over the years. So yeah, thank you for further insight on that.
So Andrew, just picking up on the last answer that you're talking about, how number of trials for COVID-19 have been taking place, but what comes to my mind is that when such a problem arises and then our whole focus shifts towards that problem, for example, COVID-19 at hand right now, do you think there has been a decreased investment in other major problems like cancer and dementia, which were supposed to take place, but because of a pandemic, they have been come to a halt, or has there been a market pullout from these technologies?
Yeah, no, it's a very good point. I think there is inevitably going to be some distraction for other sectors. There has to be. There's only so much bandwidth that people have, and so much capital to be deployed. So when you get a massive attractant like this and distractant, there's got to be some impact elsewhere. But I think what you'll see is quite a lot of variation in that impact. And you'll see some sectors hold up really, really quite well. And we will be very short term, maybe, so take cancer, for example. Cancer was absolutely flying in terms of attracting investment and attention prior to this. That's not going to change long term, but there has been, a little bit of a distractant, but we're seeing massive cancer rounds being raised, both in the portfolio companies and at fund level. So, and the other thing is there's a big momentum coming into the pandemic. When you're raising a fund and people are allocating capital, they're spending, a long time beforehand deciding where to put that capital, and there'll be big processes all still happening. COVID will have maybe put those on hold briefly, but having done all that work and decided it's a good opportunity, things like cancer, people are going to still pile into because it's not going to go away. I think the areas that will suffer most will be those where they were a bit marginal at the beginning. So pre-COVID were slightly on the margins, and some areas which were a bit less hot, are going to suffer. And so, some of the just, less hot medical areas, for example, some again things like neuro will probably have some specialists coming on through, but that might take a little bit of a hit. Inflammatory diseases, that sort of thing. There are some very hot pieces within inflammatory, but in general, that might take a bit of a hit. But I think there will be some still really, really hot areas which will just continue. I think outside of healthcare, I think the same thing applies. I think those areas like remote delivery options, whether it's food, retail, all those sort of business models will be very, very hot, and they'll continue to attract. And if you've got a fund which is set up to invest in that type of technology, you'll be able to attract more funds now. But there'll be areas where it's just going to be a bit of a graveyard, I'm afraid. Those which are sort of aviation facing, oil and gas facing, leisure hospitality for the moment will be paralyzed. So it's some really, really tricky times to get through, there's no doubt. But some streaks of hot areas to keep us all going.
Sure. Thank you so much. That was a really nice answer to understand what impact could it be on a positive and a negative side. Thank you. Over to you, Thea.
Okay, so I think Nandan and I will ask our final questions, and then we'll. I think we have a couple questions in the Q&A section, which we can answer afterwards from the participants. But my last question is actually about slightly different from not just pandemic focused, but blitz scaling is a debated model in the VC world and in general. And I was wondering what you think of it. Do you support it, or what are your views?
So I'm probably not the best person to ask about blitz scaling because partly because in the field that I invest in, it's not really that relevant in the sort of deep tech, early stage. Sort of more deep tech areas and life science sort of areas, but I think we also have technology software B2B SaaS funds, and it is a bit more relevant over that side. So I can give a little bit of a sort of overview from my perspective, but I'm no expert. So my sense is that it absolutely has a place in certain markets and certain business models. It's not something that our portfolio uses, and that's just the nature of the types of things that we invest in. But it really does have a place where you have to get into a market quickly, whether that's to take advantage of network effects, or whether it's to take advantage of first mover advantage, or whether it's typically those sort of big, fast-moving consumer markets. Often blitz scaling is required. Often where there's less. Fewer other sources of sustainable competitive advantage, where you haven't got IP or you haven't got real deep know-how. This is all just about capabilities in a business model. If you really need to make that stick and get your network effects to get ahead, then you may need to blitz scale. But in the kind of things we're doing, it's just not really relevant. So it's definitely not a panacea. it costs a lot of money to blitzscale. So you've got to make sure you get it right, and you've got to have very deep pockets. So you've got to have the right syndicates around the table, and they have to be really experienced investors and entrepreneurs, well, not necessarily experienced entrepreneurs, but they need to have a team around them which knows about the pitfalls of blitzscaling, because by nature, blitzscaling means you're getting ahead of yourself. And if you get it wrong, you're stuffed. It's a real sort of shit or bust type policy, if you like. And that's not the sort of way we invest. It's not the way everyone invests, but it definitely has a place for certain business models.
Interesting. Thank you.
Sure. So I'll be putting up some questions that one of our attendees have asked. So the first question by Robin Ravi, one of the attendees, is that, do you think that one should spend much effort convincing legacy companies and PLCs to really change their vision to meet this new reality, or just focus on newer, more socially focused enterprise who already share this vision?
Wow. Okay. So I think I can interpret that question in several levels. And I'm just trying to make sure I understand it. Are we talking about shifting legacy companies from a sort of a more traditional approach to capitalism, the sort of total shareholder value driven capitalism versus more social capitalism? Is this where we're going with this?
Yeah, I think he's trying to ask that, should we focus on legacy companies, or should we focus on companies that are already socially focused enterprise?
So look, I mean, socially focused companies, they have a place, and I guess it all depends on the degree of social focus. And you know, I think legacy companies or legacy industries, I think they absolutely need to reform in lots of ways, and I think they get this now. Whether it's environmental, whether it's sustainability, whether it's climate change, whether it's just social engagement and multi-stakeholder approach to the world, they are starting to move. They're going to be like oil tankers. It's going to take a long time for them to move. But also, one of the things which will make them move more than anything is seeing disruption going on underneath them. And so that's why it's great fun being in my kind of world, because we don't really need to worry too much about whether they're going to change or not. The important thing is to invest in the models which you think which will work. And if you got the ingredients, and you understand the ingredients of why they're going to work, if social is part of that, then great. But the important thing is to back disruptive and innovative business models. Then they will take over themselves, and the legacy companies will then have to react if there's true disruption going on. And so I think it's one where we don't need to, I guess, worry too much about the legacy thing. We can't really change. We just need to focus on the things we think are going to be good and really understand why. It's a different question, I think, is how do we change the way the legacy world works and thinks? That's a much more top-down government, multi-state driven approach of how do we change things like driving purely economic incentives. We shouldn't just be looking at total shareholder return when owning equities in private companies, but we should be looking at many other metrics to try and broaden them out. So there's lots I think can be done at a government and a sort of statewide Quango level. UNPRI, for example, is the United Nations Principles of Responsible Investing. We're signatories of that, and we sign up to a whole bunch of things that we do with our companies, just like big fund managing owners also sign up to the same principles, which is all about making sure that our portfolios act responsibly, sustainably, and so on. And those sorts of things can start to have an impact on how asset owners, fund managers can impact the way legacy companies work. But a little venture capital company like us absolutely can't. But en masse, driven by global cooperation at United Nations level, with $1 trillion funds all doing the same thing as we are down at the bottom, if everyone does the same thing, then they can have impact.
Sure. Thank you. Thank you for your answer. I hope it clears it out for Robin.
Yeah, I'm not quite sure where he was pitching it, but I hope that covers off both bits.
Great. And I have another question here. I'm going to see. Oh, sorry. So the question is, what resources would you recommend for a university student aspiring to start a VC career in a few years?
Well, it's a very it's a good question, and it's changed a lot in the last 5 to 10 years, and it's one I get asked a lot by people, you know, wanting to get into VC, whether it's for medics or not. The good news is that I think it's much more open and flexible than it used to be. The world of entrepreneurial company startups and so on, and VC funds has just exploded. The volume of companies and funds and opportunities is just so much bigger than it used to be. And that's great because it means there are more opportunities. There's higher turnover and so on, but there's lots of places to go and get experience. And I think, you know, any experience from my perspective that gives you the ability to show your passion for entrepreneurial business, your experience of it, irrespective of sector, it's just getting your hands dirty, getting your sleeves rolled up. Any chance of showing that you can be resourceful. One of the real things is tenacity and resourcefulness, is making use of very small amounts of you know, whether it's finance or people or you know, it's just being really you know, ingenious around how you use what you've got, and you know, just getting yourself into places, networking, getting to know people, showing you can influence people, you know, showing you understand different business models, showing you have experience of different business models, whether it's from inside a company, from a consultant or advisor, from inside a bank, from a funder. There's lots of different places you can get that experience, but I think boiling it down to those key sort of capabilities and understanding of what it takes to grow a company, you can get experience from all the way around that circle. It's no longer just, you know, business school and banks and consulting houses. Being involved in the entrepreneurial companies themselves is a great way of getting that experience too. So, and becoming an entrepreneur. Lots of funds in the US, for example, actually insist on people, if you're going to be in a VC fund, that you've had some sort of entrepreneurial experience. Some of them are purely set up by people who have had a lot of success starting up companies, sold those companies, and now want to go and deploy some of their own money into their own funds. Those people have all had failures as well. And so they bring a huge amount of experience from both failure and success, from large companies and small companies, from growth companies in between. And it's pulling together that experience and demonstrating your tenacity, your resourcefulness, your ambition, your you know, just your intelligence and guile, you know, just all those sorts of things, pulling them together into a package however you can. And if you show that off to us, then, you know, we'll employ you.
That's great. Nandin, you want to take?
Yeah, sure. Thank you, Andrew. The next question is by another attendee. So how has the process of investing affected the pandemic? Does it take longer now, or it is more likely, and are you more likely to invest in different areas than you used to before? So I think the overall question is about how has investing changed due to the pandemic?
Yeah, that's good. It's an interesting one because this is all new for us too, and it's changed things in a way which we weren't really expecting. So we're all using technology way more than we ever did, and we're realizing that actually it's quite good. So we're about to do our first investment where we have never met the people face to face. And if you were to ask me 6 months ago, would I invest in someone where you've never met them face to face? There's no way. So this is all breaking new ground. So that's one thing. We're just doing everything by Zoom. It has slowed things down a bit in some ways, but it hasn't fundamentally changed the process. And I'm not sure even, it's not really the technology that's slowed things down. It's just that there's a lot going on right now. And that's partly because we've had to go look. The first thing we did was take a look at our portfolio and say, how are our portfolio companies doing in this pandemic? Because some of them, their customers have literally just disappeared overnight. Some of them, their customers are banging on their door saying, I need 10 times what I did before. And for both of those, there's enormous funding requirements. So we've had to go back and just look at, well, we've got some dry powder. how much of that are we now going to have to deploy into our portfolio? And that takes a lot of time and effort. So we have been massively distracted. And so new investments certainly take a little bit more of a backseat, but we are still investing. And we are using technology to do it. And we have a little bit less dry powder, so the bar's gone up. And I think most funds are in the same place, mainly focused on portfolio. Some new investing they're trying to carry on, but they are, the bar will have gone up just because their time and their capital is more restricted. But fundamentally, life is going to carry on, and if we just have to do it all by Zoom, so be it. But actually, I'm going to be back in the office next week to meet a company. So I think those sorts of single meetings, just to say hi, just to get that sort of physical connection, that they'll be able to start happening quite soon. So I don't think it's a long-term issue.
Right. It's good that you bring it out that you've not actually met someone who you'll be investing in. So there's this principle that people say that you should invest when early stage startup. You should invest in the person who's heading the startup than the idea itself. Do you follow that principle? Yeah,
no. So we do, and you're absolutely right. And so I'm probably being a bit naughty in that this it's a bit of an outlier for us. And it's where we're investing in technologies, where actually it's the technology. And actually that one of the scientists we may have already met personally, but we just haven't met everyone. So I'm probably using it as a we wouldn't do this normally. This is a bit of an outlier just because and there's a timing pressure on this particular deal, and it's driven fundamentally by the technology. But you're right, that one of the key things that we have to look at when backing a company is the management team. It is absolutely the number one thing, and it's very hard from our experience to get a connection without meeting them in person. But that's our old paradigm. That's what we've always assumed. What we've never done is test it. And what I think is a really interesting thing is that we're testing this now. And I don't know if there's a great book called by Malcolm Gladwell called Talking to Strangers, which is a book I'd recommend for, it's most apposite right now, because we are all having to talk to strangers in a very different way without actually meeting them. And one of the things that book basically sort of says is that our sort of conscious bias for thinking that we have to see eye to eye with someone, literally physically, is completely misplaced and actually can be destructive. And that the more you remove yourself from that and purely deal in data, often the decision-making becomes better. Now he applies that to lots of different scenarios, and it's a fascinating read, and I'm sure there's some truth in it. But whether it applies to investing, we can't tell. But I think we will definitely have less contact in the next 6 to 12 months in our investing than we would have done 6 to 12 months ago. And I think it's going to be an interesting experiment to see how that goes.
Sure. Thank you so much. Thanks a lot for the book recommendation as well. I hope all the attendees have noted it down and would probably read it over the time.
It's a fascinating read, as are most of his books.
Yes, thank you. I think we have time for maybe a couple more questions. We have quite a few on the Q&A. There was another one which asks, which VC company or startup do you think, in your opinion, reacted to the crisis promptly and effectively?
So I missed the beginning of that. Which
VC company or startup reacted to the crisis promptly and effectively?
Ooh, well, I hope I should be able to say that Albion reacted promptly, and so we did. I mean, we had a lot of our portfolio companies reacted very quickly to be able to provide, because a lot of them are in digital health. They have a lot of impact, and so we had about 7 or 8 companies quickly switch their business models to try and help. And we looked at a number of things, also backing technologies for ventilator capacity, for therapeutic discovery, for data collection for vaccine trials. We've got a whole range of companies in the portfolio which switched, and I was just astonished. Within 2 weeks, they were switching their products and so on. And so we actually put out a note to everyone saying, look, we're still open for business, and here's our portfolio. It's still doing a lot of cool things for COVID. but no, we were quick, but we probably weren't the biggest, in terms of changing the way we do things. And we probably weren't the quickest either. Look, I don't know, to be honest. I think a lot of the big names, so Andreessen Horowitz, and Index and Balderton and people like that, they're very, very slick in all this sort of stuff, and they think about these sorts of things very hard, and they've got very good external comms, and they all came out with some, with really quick reactions. But I think teasing apart just what's the reality going on under the surface and what's the sort of the PR on top. I'm not sure you can necessarily tell who's really changed things. But I think most VCs, they're not looking to change their model. Their funds are set up, they have to invest in a certain way. They may slightly change what opportunities they invest in and how they analyze a particular investment, but fundamentally the model won't have changed.
Yeah, that's thank you very much.
But actually, I know I would say there are some funds in the US so there's now an opportunity. I think some people saw an opportunity in the first 2 or 3 months to really get into, say, the home delivery companies and these to back companies to make those big pivots. And there were some deep capital funds, mainly in the US, and I can't remember exactly which ones, who just they went to their LPs and just said, look, this is our time. Just give us some more capital and let's just go for it. And so there are some funds who went for that particular opportunity. That doesn't really apply to all funds. It doesn't apply to us in sort of in B2B SaaS and in healthcare and life sciences, or in the UCL Tech Fund. So for us, it's business as usual.
So I have, as a sort of roundup, I have a question about whether you think is your view post-pandemic in the VC world, is it a positive or a negative outlook? Are you feeling optimistic?
I keep having to check myself. I am quite optimistic, and I keep sort of thinking, should I be optimistic? Am I just being a bit foolhardy? But I think it's partly because I'm in the sort of health and life science sector, and where that converges with technology. And so I see a lot of opportunity coming out of this medium and long term. I do have to keep checking myself occasionally and thinking, the economic fallout from this could be massive, and it could be for a couple of years. But when I think back to living through the 2008, 2009 financial crisis, that looked super scary at the time as well. And you get through it. And actually, in retrospect, a lot of the opportunity coming out of that was shortly after that. And that's, as investors, we have to have buying periods. And actually, prior to the pandemic, prices and stuff was so high that actually was not a good investment time. Lots of opportunities, but investors need opportunities at the right price as well. And this for us is a buying opportunity because, in general, if you've got a combination of sort of economic dampening, but hot sectors that have got great opportunity, the economic dampening can take the froth off some of the valuation in some of those hot sectors, which means you can get access to markets which are still growing long term, but should be at more reasonable prices. And that for us, I think, is we need to be in markets that are growing long term and where there's sort of really good business model opportunities. And the markets we're in, the sectors we're in, have all that, but the economic dampening takes the froth off those valuations. So we think now is a great sort of investment opportunity. That all is assuming that the economic downturn is not so grave that it flows over into those hot sectors that we're trying to invest in. And there's no doubt that there will be some overflow into that, because no one's budgets are, healthcare budgets are not bottomless. So there will be some distraction. So we still have to get it right, and there will be mistakes made. But I think all in all, I'm on the more positive side than pessimistic.
That's really nice to hear. Very encouraging. Nandin, do you have any last questions to add?
Yeah, I think we'll just go with the last question as this hour has almost come to an end. So this is more of a career advice by someone, and they're asking that if they're already a working professional, for example, a scientist, how could they enter the VC world, and how could they start their journey as in a VC fund?
Yeah, another question
company?
I get asked a lot, and a good one. It's Again, it's much easier than now than it used to be, because there are more opportunities and the more scope for putting together the core skills and capabilities that you need to demonstrate to get into VC. So there's more variety. You can come through many more routes. And I think, yeah, the important thing is to understand is that VCs are quite small. We don't have big training infrastructure. We can't really train you massively on the job. So you need to have some basic capabilities and understanding to come in to get a job in VC. Every VC is different as well. That's the other thing. There's a huge variety, and some require slightly more tick boxes and a more structured training and all these sorts of things. Others are much more prepared to take people with just the raw capabilities. And some people actually like to have people from a less structured environment, maybe from an entrepreneurial background. So my sense is horses for courses. If you want to go get a more structured training and go into banks or consulting houses or accountancy degree, and then that's all fine still, but you don't have to do that. And so you can get a commercial training also in companies and hands-on experience in seeing the problems that small companies can have and actively dealing with them in a small team, getting your hands rolled, your sleeves rolled up and your hands dirty. That sort of experience really counts for a lot now. But at some point, you probably do need to get some kind of structured training, whether it's business school or something, or working for a larger corporate or something which shows that you just know what quality looks like. That can help. Having said that, there are people who will just hire on the back of, I just think you're great and you're dynamic and you're ambitious and all those sorts of things, are resourceful, intelligent, and there is a lot you can learn on the job. And so some people are more open-minded. We're quite open-minded hirers. We believe in training on the job, and you learn on the job. Some people prefer to have the fully baked entity before giving a job. And I think the biggest thing I'd say is go out, meet the teams, meet the different VCs, get a sense for what they're like, what they look for, and find out where you fit in that. Some companies you will fit, and some companies you just won't. And work out what fits best for your personality and your skills.
Thank you so much. That answer really guides all of us who want to actually go into VC and probably look at it as a career prospect. Thank you so much.
It's great fun as well. I can tell you, VC is a great career. So you're all very sensible to want to get into it.
Thank you.
Andrew, all of your answers have been so helpful, and we're all so appreciative of you taking the time to do a webinar for us.
My pleasure.
The corona and the pandemic has been an interesting time for everyone, and we have all been affected. So on behalf of UCL Entrepreneur Society, we hope everyone's families are well and stay safe and healthy. And thank you so much for joining our webinar. It's been great to have you.
Your pleasure. Well, thank you for having me. It's been great, and do stay in touch. Yeah, of course. Thank you.
Of course. It's been a pleasure. Thank you. Thank you, everyone who came to
listen. Thank you so much. Bye.